Hi, good afternoon. I'm Kirsten Neese with Cornerstone Homes. Today we are in the Winchester model at Chickahominy Falls, and I have with me Neil Sweren. He's with Atlantic Coast Mortgage. Neil has been with our concierge program since inception, which is over 10 years old now. Neil has done a number of different loans with us, but he offers a really unique product for our buyers today, and one that I think is really important for everyone to know about, considering our current interest rates and kind of the whole banking situation. It's a great tool for those looking to make this move to consider for their financing options. And we've seen an increase in these types of loans recently, and just felt like it would be a great topic for us to discover. So thanks for being here.
Thanks for having me.
So Neil, what is it called? You offer a product called a HECM loan, a reverse mortgage. Tell us a little bit more about that.
So a lot of times we'll say HECM loan because sometimes people get scared of the term reverse mortgage. But it's really all HECM loans are reverse mortgages. Not all reverse mortgages are HECM loans. We use it here as a tool to help people be able to buy and more affordably to better afford to live in the house. And how do I want to say this? We use it as a tool here to help people more affordably buy and buy the house that they really want.
Right. So with a reverse mortgage, what does that look like? Why is it so different than a traditional mortgage?
It's a good question. So most people think of a reverse mortgage in terms of what you use for a house you already own. But about 10 years ago, the FHA started allowing the use of this program for a purchase transaction. So that's when Cornerstone got involved in the program. And what happens is a buyer can come to the table, they make a down payment on the house, and then FHA HECM loan allows them not to make a mortgage payment on the amount that they're borrowing from us. They can make a payment, but it's not required.
Okay.
So a lot of our buyers come into it thinking that they will make payments. Maybe they're not quite retired yet, they're still working, they have enough income, but this is a great option for them because it provides them a lot of flexibility. They can make payments on a loan for a year or two, 5 years. If and when their financial situation changes, they can stop making payments. We don't expect payments. We don't require payments. There's no extra credit.
Okay.
You don't get a bonus for making payments.
Right.
You can just switch gears at any time, which is different than a traditional loan program. If you think about it,
You're obligated to pay.
You're obligated to pay. And if your financial situation changes, loss of a spouse, healthcare expenses increase dramatically, you can't just call your bank and say, listen, we don't really have the money this month, so we don't want to pay anymore. With a reverse mortgage, this program allows you to have the flexibility you need in your retirement years to be able to switch gears at a moment's notice when necessary.
So say I wanted to look at your option. What are some of the restrictions or things that why it's such a great product for buyers in the 55 plus active adult community?
It's great because a lot of our buyers are coming from a situation where they have a house to sell. They've sold that house. Maybe they didn't walk away with quite enough to write a check and pay cash for the new house.
Okay.
Or maybe they don't want to put all of the cash from the sale of the house into the new house. But they also don't want the monthly obligation. From a cash flow standpoint, they want to try to make things as affordable as possible. So this allows them to take some of the cash from the sale of their house, make a large down payment on the new house, and finance a portion of it still without having that monthly payment obligation.
Okay.
That's the biggest reason people use this program, is to avoid having to borrow the money through traditional means. There isn't another way to borrow money without having that monthly obligation.
And so if they get a loan from you for, say, $200,000, what does that look like? And how does that age over time?
So if the borrower is not making payments on the loan, the interest just gets added to the balance. At no time is the borrower required to make payments, as long as they keep current on their taxes and homeowners insurance, and still live in the house.
Okay.
It's for owner-occupied transactions only. Now, I know you guys don't really sell to investors, but this is limited in use for older home buyers and homeowners that live in the house as their primary residence. You can travel. Like you had a client once a buyer who had a mobile home that, they traveled most of the year, but the house they bought was their primary residence. We don't care. Really, some people say you have to be there at least 6 months. That's not really the rule, but it has to be your primary residence.
And you have to be 62, is that right?
At least one buyer has to be 62 or older.
Okay, so then if I'm making a purchase and it's $200,000 and I don't make any payments and I live another, 10 or 15 years, the loan payment essentially...
The loan balance will grow over time.
Right.
We don't know exactly what that will be. It depends on interest rate, depends on how long you're there. But these loans are all non-recourse and insured, which means FHA is insuring the loan so that the borrower and their heirs never have to worry about being responsible for any shortfall.
Okay.
If the house appreciation doesn't keep up with the loan growth, borrower's not responsible. Even if they have $1 million in other assets, not something we can touch if they end up short at the end. It's rare that happens, but the borrower is not responsible. In most cases, the growth of the loan and the home appreciation keep pace with each other, so that if you go into the transaction with, let's say, $200,000 in equity, 10 or 15 years later, you still have about that much equity, because
your home,
if the home is growing at, let's say, 4% and the interest rate currently, like let's say in the sixes, it's only half of the balance. So so your home growth is still outpacing your loan.
So at the end of the day, should you need to sell your home, you're still going to be able to get all that equity out and use it in another way.
When the house is eventually sold, in the vast majority of cases, there's still plenty of equity for the homeowner if they're still alive and moving to another place, or in the case where they've passed away and it's their estate selling the house.
So for somebody that's purchasing today, then they get the beauty of being able to live and afford a house that's $500,000 and only putting $300 down. And I'm just using these numbers for real. There's, I'm not sure what the limits are in value, but then they just get to live without having to pay $200,000 worth in mortgage costs over the time, except for the taxes and real estate.
Correct.
Seems like
so basically, their recurring expenses are the same as if they own the home free and clear.
Right.
And we've had people do some pretty creative things with it. We had a client who said, "No, I want to keep making payments." They were in their 80s when they started, and they wanted a 15-year loan. So we told them what the payment would have to be if they wanted to pay it off in 15 years. They wanted to, by the time they get to 100, they wanted the house paid for. Everybody has their own goals. But they knew that if something happened to either one of them, the other would not be forced to sell. If at that age, strapping yourself into a 15-year loan term can be very risky, because if something happens, which it is likely to, you really don't have a lot of flexibility there. So this gave them that flexibility, and they've continued to make those payments every month. The other big advantage is that when you pay on a reverse mortgage, everything you pay you can borrow back later. So in this case, it's actually a great strategy for them. They have the money and can afford to continue to make monthly payments. If something happens and that changes, they'll have a significant amount of funds available in a line of credit they can borrow back, whether it's for healthcare or home improvements or anything that they wanted to do. That gives them great flexibility. One of our clients actually used the funds in his line of credit to help his daughter through a tough divorce situation.
Sure.
It really can be used for anything.
Yeah, so it's just like a home equity line, basically.
Just like a home equity line, but with no monthly payments.
That's fantastic. I wish I was eligible. But no, this is a great product, and we really do believe in it. Our owner has always made sure that you were part of our team and really values this product. And we do want to make sure that our home buyers are aware of it, and that your expertise. Neil was the first HECM loan in the state of Virginia and continues to do well with this product with clientele both in our communities and throughout the state, I'm sure, in the area. So thanks so much for being with us
Thank you for
today.
having me.
Should somebody want to contact you, what's the best way to do that?
So any of the sales associates can help,
Yeah.
but you can reach me by email or phone. You want me to give that information now?
You're welcome to give it, or we'll put it in our show notes. But if you have a great, easy email that you want to share.
Sure, it's Neil, Neil, at lowrateloan.com.
Perfect. Well, we appreciate your taking the time to be with us today and share this amazing financing tool with our home buyers today. And we hope that you found this valuable and look forward to seeing you on our next episode. Thanks so much.
Thank you very much. Thank you.
Have a good afternoon.